So that is the question for December 2022. Question number 1. That is the revision. December 2022. Question number 1. And the question says that the management of college publishers has estimated the following initial cash outlays and net cash flows and probabilities of a new printing process in each scenario, in each case scenario. Year 0 is the initial cost of the new printing process. Year 1 to 5 are the operating net cash flows, and year 5 star is the estimated salvage value. The firm's cost of capital for a project of average risk is 13% per annum. Required. Assuming that the above project has an average risk, compute the expected net present value, that is ENPV of the project. Also perform a sensitivity analysis of the salvage value if this variable changes from the base case value by positive or negative 80%. Assume that all cash flows are positive, perfectly correlated, and that there are only 3 possible cash flow scenarios over time, namely the worst case, most probable, and best case, with probabilities of 0, 2, 0.2, 0.6, and 0.2 respectively. Determine the project's standard deviation of net present value. Now, my focus should be on the first part, because that is what we have covered already in class, and the sensitivity part. So we'll be able to do the first part, the NPV and the sensitivity. Now, in this kind of a scenario, what is the starting point? Kwanzaa, which kind of sensitivity is this? Can somebody identify the kind of sensitivity we are dealing with out of the ones that we've done? We have done 3 sensitivities. The last one was called a special sensitivity analysis. The first 2, we have impact sensitivity analysis, we have break-even, then we had scenario analysis. So which one are we dealing with? Which one are we dealing with? In this case study. Yeah. Which one have they given us? Waziri Ruth. Lea hapana kuongea. After reading that question, which one do you think we are dealing with? It is scenario analysis, right? Yes, thank you, Edwin. It is scenario analysis because we are looking at different scenarios. We have the worst case scenario, the most probable, and then the best case scenario. So now, what is the first step when you are dealing with scenario analysis or sensitivity analysis in general? What is the first step? Now that you know it is sensitivity analysis and to be specific, scenario analysis, what is the first step? In any sensitivity analysis, what is normally the first step? The first step, so the first one determine NPV. Which NPV? Now calculate for me that NPV. I want to see the answer. Calculate the NPV. I'm giving you 2 minutes. Can you hear me? You can.
Yes, Molly.
Yes. So the first thing is to always, whenever you are given any sensitivity analysis, the first thing is to ask yourself, how do I get the base NPV? The NPV. Now, in this case, they have not asked you about the base NPV. What they have said is that you need to calculate the expected. Assume that the above project has an average risk. Compute. So why are they saying average risk? Because we have worst case scenario. So in the risk in worst case scenario is the same as the risk in best case scenario and the risk in most probable, which we call the base. So risk is equal. So we are not saying that if the economy is doing poorly, the risk is high. They are saying that the risk is the same, so don't worry about the risk. What you're now looking at is the average NPV, which they are saying the expected NPV, that is ENPV. Now, how do we get the expected NPV? Normally, when we are looking at NPV, we always say that NPV is the cash flow times PV per or PV, depending on the nature. We have R and then the years minus IO. But because we have different scenarios, you need to get the average for all of them. So that is why we call it expected, the same as average. So the average, how do you get the average? Whenever you're given probability, the average is always gotten by multiplying the outcomes with the probability or the cash flows with the probability. So that means that for us to get the expected NPV, we need to get the expected cash flow, then we get the expected IO, the expected cash flow and the expected IO. So that means that we need to get average out of what we're given. So let's start by getting the expected initial cost, which is IO. Expected IO. Expected NPV, we can get step 1. Determine or calculate expected IO, which we can get. So expected IO is equal to 0.2, which was the first scenario, because we're getting the average. So multiply the IO in the worst case scenario with the probability, add with the product of IO in the second scenario and the third scenario. So we have the IOs. The first one was 100, they are the same. 100 throughout. So we have that times 100. That is the first case plus the second one, 0.6 times 100. That is for the base case. Then we have 0.2 times 100. Then you are going to have an average for all the scenarios. We are getting average not for one scenario, but for They're all scenarios, the three scenarios. That is why we call it average. It is like you are doing business throughout the year. When you're doing business throughout the year, you'll get income for January, revenue for February until December. And then you can be told to get the average. Normally what we do, we add all of them, then you divide by 12 so that you get average revenue. For a situation where you are given probability, you multiply the probability with a month plus the probability with the second month's revenue, right? Plus the probability times second month, third month's revenue, then you add all of them. That gives you the average or expected. So that is the average or expected. So how much do you get here? And that will be our average IO, which you can now use to get average NPV. What is the answer? Start with that. Then we can go to the annual cash flows. Average annual cash flows. So that is the first thing. That is step one. Step two, average or expected annual cash flows. Remember, the cash flows are the same. In worst case scenario, it was 20,000 throughout. In the second scenario, it is 30,000 throughout. The best case scenario, it is 40,000 throughout. I hope that you are seeing the notes. So that means that in year one, the behavior in year one is the same as year two, year three, up to year five. Given any scenario, they are the same throughout, right? So that means that if you get for year one, we can say now all of them are average for the whole 5 years. So average here, we are going to have the cash flow which we call expected annual net cash flow, which we can now get as, so it is expected net cash flow. We can get it by having 0.2 times the cash flow in year one, which is 20,000. Plus 0.6 times the cash flow in year two, which is 30,000. Plus cash flow in year three. So in the third scenario, so the probability there is 0.2 times. How much are the cash flows? The cash flows are 40, right? So calculate for me the cash flow. Calculate for me the cash flow. So we have got our average cash flow. We will get average IO. What else are we having? We are given the salvage value. So that means that this formula should have been like that, plus salvage value times PV, because it is 1 minus IO. So because we have salvage value, we need to add salvage value plus now the cash flows. So our salvage value, we can get the salvage value as well. So you say step 3, expected salvage value is given us the probability times the salvage value. Salvage value is 5. What are we given as the salvage value? Five star is the salvage value. Down there, we are told on the statement, year 0 is the initial. When year 5 star is the estimated salvage value. estimated salvage value. So what we are calculating is the average. So we have the first one, 5, plus now the probability of the second one. The second one is 20, plus the third one is 0.2 into 0.2 into 30. That's that. So get me the salvage value, the annual cash flows, because they are regular. Whatever answer you're going to get here is the annual one, and then we have also we have this one here. So we should be able to have all of them. Calculate and share with me. Tell me there IO is what, which figure, annual average cash flow, and then the salvage value. So the salvage value is 19,000. Salvage value is 19,000. Then we have 30,000. Here, and then 100,000. So tumepata what we require so that we can be able now to perform our NPV. Can we now calculate NPV? Because already we have expected cash flow, expected salvage value, expected IO. So we can now get our expected NPV. Now, our expected NPV now, we can say that expected NPV, which we call ENPV, we can now say that the average cash flow is 100,000. Is that what we calculated? Average cash flow is 30,000, so we have 30,000. And because it is similar throughout the period, as you check, you'll be able to see it's similar throughout the period. So we have that times PVFA. So it is the same throughout. It is average for year 1, average for year 2, they are the same. So we are using PVFA. So PVFA here is 1 minus 1 plus R negative N all over R. Right? Plus the salvage value, now we got it 19,000 times PV, which is 1 plus R negative N minus IO, which we have seen. IO is 100,000. Sindio? 100,000. IO is 100,000. So we are having our 30,000. Get me the PVFA figure. That's gotten the
Kamu togi. You can tahia with the kikombe. Kalau unyamerelia ka.
Get me the figure. I need to know the PVFA. It is 3.5172. Because you have used the 5 years. So the period here is 5. Rate you have used. Rate is 13%. So you have used 13%, 5 years. Thank you. 13%, 5 years. So that is calculate for me that. Then 19,000 times. What is the figure there? 0.5428 minus 100,000. So the key thing here is that when you are asked about the average, then you need to get the average for the 3 outcomes: the worst case, the possible, and the best. And how do you get it? Multiply each case with its probability plus another case and its probability. That is how you get average. When you're given probability, the average is always the figure that you're given times its probability. Then you add all of them. You'll get average for year one. If they are the same cash flows, then you'll assume that now that average is for year one, it is the same for year two, year three, and therefore we are using the PV file. Sawa. The same case comes here, only that here we are using PV because it is only once. It is different. Look at year 5 star. 5 star is the same. It is only a single figure that is not recurring. Like year 5 star for worst case, a single figure 5,000, then 20 for most probable, then 30 for the best case. So what are you having here? Ruth is saying that the figure is 15, 8 to 29. Point 20. Can you guys confirm that that is the expected NPV? So in exam ukiambiwa NPV is different from expected NPV. This is the expected NPV. You get it? By multiplying or getting the expected figures, expected cash flow, expected salvage value, expected IO, and such like things. I hope that you guys are now okay. It's 29,200, eh? 200, not 20. Hiyo ndio mnapata? Kama hiyo ndio mnapata, that is fine. So I want us now to look at the second part, which is sensitivity analysis of the salvage value. Now they are saying that a sensitivity analysis of the salvage value, if this variable changes from the base. So what is the base? What is the base salvage value? Forget about the first one. The first one was expected, where you get average for all of them. Now in the second scenario, they are now splitting the outcomes into worst, base, and the best. So what is the base? The base salvage value. Because we are told that you need to perform sensitivity analysis on the salvage value and check how it varies from the base. So what is the base salvage value? Who can tell me the base salvage value? From the information that you're having. 12,000. The base salvage value. Look at the information. Forget about Roman 1. In Roman 2, I want you to tell me what is the base. It is 20,000. Base is the one in the middle, the most probable. The most probable. Then we have the worst and then the best. The most expected. So it is 20,000. Now, it means that now 20,000 will act as the base. And so we want to see how they vary from this. So we are told a sensitivity analysis of the salvage value, if this variable changes from the base case value by positive 80% or negative 80%. In the worst case scenario, the salvage value should go down or upward in the worst case scenario. Because we have two options. We have 20 in the middle, then one can be positive, another one can be negative. So when we start with the worst case scenario, is it when the salvage value should be negative or positive 80? The worst case, want to get the change. Under worst case, what will be the salvage value? Hapo kwa worst ndio salvage value itaenda juu ama itaenda chini? Nauliza tumeambiwa that we have base salvage value which is 20,000. Now we need to perform sensitivity analysis, and we are being told that in this sensitivity analysis, the salvage value can either be positive or negative. And we know that in sensitivity analysis, we have to compare the two scenarios, the worst and the best. So one of them must be positive and another one must be negative. So according to you, from your understanding, do you think that the worst scenario itakuwa negative ama itakuwa positive? If it is the one that is going to be negative, then we need to go ahead and calculate what will be the worst case sensitivity analysis, meaning the worst case salvage value will go down because it is cash inflow. Yes, cash inflow, it is negative when it goes down. So our salvage value should be down in the worst case scenario. So forget about what you're given there as 5,000. Wamekupea 20 as the base, and then they are telling you that in the worst, it will go down by 80%. So what will be the new salvage value according to Roman 2 question? Forget about what is there in the table. Look at the statement. It is going to be moving from 20, losing 80%. What will be the new salvage value? So let's look at the scenarios. Changes in salvage value. So we have different scenarios here. We have worst scenario, worst case. Worst case has got a probability, which is 0.2, but we are being told that the salvage value will now change. So we are going to have, we are going to lose 80%, meaning that what we are going to have is only 20%. So it is 20% of the current 20,000 that you're being told. So 20% of 20,000. All right, so this probability. And then we have our new salvage value. So salvage value. So the probability still remains, but the new salvage value is going to be only 20%. We are going to lose 80. Then we have base case. The base case, the probability is still the same, 0.6, but the salvage value will remain the same. Under base, it doesn't change. So our salvage value here should be 4,000. And then under this is going to be 20,000 remaining the same. And then we have best case. In best case, we are told that the salvage value will go up positive 80. So the probability remains the same, but positive 80 will now be 1.8%. So it is 1.8 times 20,000. Imeenda above 100 by 80%. So it is 1.8. Or you say 180 all over 100, which is 1.8. Sasa imeongezeka. So that is a very good scenario. It is best because the salvage value is an income or cash inflow. So it is positive when it goes up. Or we can say that it is the best when it goes up. Therefore, our new one is going to be, what is going to be the new one? When you multiply this, you're getting 36,000. These are the new salvage values. Those are the new salvage values after the sensitivity change. Now, we are being told, now, assuming that the sensitivity analysis of the salvage value, if this value changes from this. Now, what is the new expected with this change? After varying the salvage value like this, what is now the new expected NPV? Under sensitivity, we are looking at the changes in NPV. So what we are given here is the new phase of the salvage value so that we can go and look at the change on the sensitivity as a result of change on the salvage value. the change on NPV as a result of the change on the salvage value. Sijui kama tunaelewana. Nasema whenever they are trying to set sensitivity, they are trying to look at the movement on NPV. And you need to change one variable at a time. In this case, they are only changing the salvage value. And they have told you how it changes. These are now the salvage value. The first one we had seen, as per the statement, it was 5, 20, and 30. But now in the second scenario, it is now 4, 20, and 36. What does this change has on the new NPV? How will our new NPV look like? We know the original expected NPV. That means that with this change, we need to ask ourselves, what is now the expected NPV? And for us now to get the new expected NPV, we need to get the expected salvage value after the change. So we need to determine the expected salvage value. Determine new expected after the change. Because that is the only thing that has changed. For us to get the NPV, we need the salvage value, the cash flow, and IO. Out of those three, the only one that has changed is this one. So after this change, what do we expect? So we are having 0.2 times 4,000 plus 0.6 times 20,000 plus 0.2 times 36,000. So what is the new expected NPV? The new expected NPV, the new expected salvage value, sorry. New expected salvage value ni? Now najibu haraka haraka. The new expected salvage value, what is the answer for the new expected salvage value? The old one we know, the old one was 19, right? Yes, the old one was 19. So the new one ni ngapi after this change? Alafu tutatumia hiyo sasa to calculate the new NPV. So you are saying that our new salvage value is 20,000. Are you seeing? We have moved from the expected of 19, expected 19,000 to expected 20 because of the changes. So can we calculate now our new NPV with the new salvage value? Because we are told to calculate sensitivity, and sensitivity we need to get the change on NPV as a result of the changes that we have seen. So we have new expected NPV. NPV is equal to, our cash flow still remains the same. The cash flow was how much? The cash flow was 30,000, right? So we have 30,000 times PV first still remains the same, which was 3.5712, right? 172. 172 plus, now the salvage value has changed to 20, so we have 20 times 0.548, 428, and then the cash outflow remains the same, which was 100,000 times. Do we have any times? It was just 100,000. Just 100,000. So you can say this one minus 100,000. So what is our new ENPV? Our new expected NPV? Mana vile ni rahisi. So LM class will start from 8:30. Leadership and management will start from 8:30. Kwa hivyo bado tutaendelea for the next 30 minutes. Yeah, tutaendelea for the next 30 minutes. Na inafaa mchangamke kidogo. I hope that you guys are able to see the question. The question was December 2022, question number 1. That is what we are going on with, and I shared it. So as you move on, you check. Now, this is our new NPV. Now, if somebody asks you now to calculate the sensitivity analysis on this, that was the question. A sensitivity analysis of the salvage. So as a result of the changes on salvage, we have sensitivity analysis that we can do. So it has gone higher from what we were having. Initially, it was 15,000, right? Initially, it was 15,000, but now we are having 16. So is it positive or negative? So you don't say adverse, you just say percentage change in NPV. Percentage change in NPV, because already we know it is positive, is equal to new minus all over, in fact, ENPV all over all. So we are having 16,372 minus, the other one was 15. It was 15, 15, 15. 829. By 2, right? All over 15, 829.2. Is it just 16,000? Ama kuna decimals tumeacha? Hii ni 16 exactly, ama kuna figures tumeacha? I don't know. So get me the correct the percentage change. Is exact, eh? So we have 3.43%. 3.43%. Do you have any challenge there? I want somebody to tell me whether you have any challenge. If it is well understood, everybody should comment that it is okay, understood. Comment that you understood. Comment that is understood. Understood. Ruth is okay. Mas is okay. Eugene is okay. Waziri ako sawa. Henry and Mercy. Henry and Florence. Not quitting. What is the problem? Okay, so let's look at another question. December 2021. Natafuta zile rahisi ndio tufanye haraka haraka. Somebody can share on WhatsApp the question, the question on the meeting. Kindly share hapa kwa meeting that question. Share December 2021 question 5. December 2021 question 5. Question 5. Question 5. Have you seen the question? We shall be doing as many revision as possible so that you guys can get comfortable with the questions. Nataka to understand the logics. I need to understand the logics. I wanted you guys to share here for meeting, but let me see what I can do. 2021 December. So we have just done this one. This is the one that we have done. So we need to go to 2021 December. Yes. You look on nauliza question 3. Let me see that question 3. Kuna nini? Question 4. The following now question 3. That was the mergers. Here in topic 5. I was talking about topic question 5. This one. So this one, advice that due to. Yeah, now this one. Are you seeing the question? Question 5A. Now the question says that an investor is considering introducing new classic pens into the market. The firm is contemplating investing in purchase of a new plant costing 250 million. What is 250 million? What is it? What do you think is 250 million? Unajua ukisoma question nafaa unaelewa from the start. The first sentence imeingia, the second inaingia. So the first one imeingia, IO, thank you. So that is the cost of the machine or the project. Now the plant has a useful life of 5 years and is not depreciated to zero on a straight line basis, and is to be depreciated on a straight line basis. So that means that if the plant is being depreciated to zero, it means that there is no salvage value. Hakuna pesa utapata kwa hiyo machine, inaisha yote. So that means that the full figure, which is 250, is going to be fully depreciated. So can somebody calculate for me depreciation amount? What is the amount of depreciation per year? I'm giving you 2 minutes, amount of depreciation per year. So some of you have tried it. That is correct. Depreciation is 5,000. So you can say that IO, that is December 21. Question number 5A. IO is equal to 250 million. Depreciation is equal to 250 million minus 0 because there is no salvage. Salvage is 0 divided by 5 years, which gives us 5,000, 5 million, or so 50 million per year, per annum. That is correct. It says that due to market uncertainties, selling price per unit variable cost, and annual sales volume of the new machine or the new classic pens have been estimated stochastically as follows. The unit price is given, unit variable cost is given, annual variable costs are given. So this is what is expected. There is a probability that it can be 25%, 25 shillings. There is a probability that the price can be 35%, and then it's 35 shillings and 45 shillings. So it means that if you want to know the cost that we're using here, you get the expected price. How many can get expected price? Expected, whenever you're asked about expected price, it is normally the price times the probability plus price times probability plus price times probability. The answer is the expected price. Now we also have expected variable cost. You know what variable cost means. And then we have expected values we can get. Just this one, that is 4.5 times 30%, 6 million times 40%, 70 million times 30%. You'll get the expected, which is called the average. The firm will incur annual fixed operating cost in excluding depreciation. So this cost does not have depreciation in it. It is just a normal fixed cost before depreciation. They know depreciation you can calculate. It is 50 million. Out of that 50 million, we have normal fixed cost. The company's cost of capital is given as 10%, and corporate tax is applicable as 30%. What do you remember about depreciation when you are given the tax rate? What happens to depreciation when you have tax rate? What do you remember about depreciation whenever you see tax rate? Unajua, I know most of you are very busy. Sorry. Whenever you see tax, depreciation becomes relevant. Inakuwa muhimu sasa. It is important now because it will help us to calculate tax. So, anyway, that is what I expected from you. You say whenever you see tax, depreciation is now relevant. Now, we are told that there is tax. So our question is, how do we get the expected net present value? When you are just told expected, just know that you're going to get expected cash flow, you're going to have expected salvage value, you're going to have expected IO. If the IO also has probabilities. If the IO doesn't have probability, use it the way it is. If it has probability, get expected at IO, the way we did the other one. So now, for us to get the cash flows, we need now to calculate the free cash flow, expected free cash flow. And how do we get it? We need to know what is the revenue. After calculating the revenue, we subtract all the deductions, and then we now have a free cash flow. So we start from there, and we are using expected figures. We start with the expected price, because it is from there that you can be able now to get your expected revenue. So price and quantity. So let's start. So how do we get the expected price? We are going to calculate expected NPV, but we need to first know what is the revenue, what are the expenses, then we get the net cash flow. Now from net cash flow, we can now get expected NPV. And of course, it is going to be expected net cash flow because it has been made up, it is made up of expected items. So let's get expected price. So the expected price is basically the average of all the prices that you're given, and then we get the expected quantity. So then that is 25 times how many percent? 30%, 0.3 plus 35. You are seeing that times which percent is that? 50% and 0.5 plus this other one is 45. 45 times 0.25. 25 or 20. So that gives you expected price. Calculate for me that, please. Then we go to expected variable cost. So expected variable cost. So price is P, we call it P. Expected variable cost which is V, will be given as 10 times 0.2 plus 15 times 0.4 plus 30 times 0.30 times 0.4. Then now we have our expected value or volume, expected volume, which is the same as quantity. The expected quantity is 4.5 times 0.3 times plus 6 million times 0.4 plus 7.5 times 0.30. Those are the expected items. They are going to help us get the value. Expected 34.20. Thank you so much. So you are saying that the expected price is 34 shillings. Expected variable cost is 20. And what is the expected volume? Expected volume. So let me write that 34 here. Then we have 20. Give me the expected volume, the average volume. Thank you so much. So that last one is million. The rest ones are shillings. The rest are shillings. Now I can wrap this. Allow me to wrap this so that we can have more space. We have our prices. So we can calculate the statement of free cash flow. Leo. Statement of free cash flow. So you say statement, just the way we did the other one, of free cash flow. So the first thing that we do, we get revenue, which is the expected revenue still. So that is expected revenue. We have 35, no 34, right? Times 6 million. That is the quantity still. What is the revenue? Then now we have variable cost. We have 20. It varies with the quantity. So it is 20 times 6 million. I know this one I can calculate 120. This one I can. Calculate only the first one. Then we have now, what we're going to have here is what we call the contribution. That is the total contribution. Now from here, we can now subtract our fixed cost. So what is the fixed cost? Less fixed cost. Fixed cost, we are told, excluding depreciation. Excluding depreciation is 20,000. 20 million. In 204 million. So what is your profit before depreciation and tax? Get me the earnings before depreciation and tax. What do you get here? 64,000 or 64 million. Now less depreciation. How much was the depreciation? Depreciation was how much? Still, that is the earning before tax. Now tax, less tax at 30%. 30% of this ni ngapi? 42, right? So hiyo ukicalculate hivyo inabaki, is it 9? 13, 9. Right. This one is earnings after tax. Earnings after tax. Now add back depreciation. Kazi yake imeisha, you add it back. When you add back depreciation, you get, so you add 50,000, 50 million, sorry. So you're going to have 59,800. Are we together, guys? Is it flowing? Is it flowing? Is it flowing? Let's do it very fast. I think LM is about to start. So let's do it very fast. Now that is our cash flow. So if it is our cash flow, this is now the free cash flow, which we call free cash flow, expected free cash flow. So it is expected free cash flow, expected free cash flow. Let's do it very fast. Now our NPV, our expected NPV is equal now to expected free cash flow times PV. Is it PV or PV? We are told annually still. So it is PV. What is the rate? Rate was given us very, very fast. We only have 1 minute, very, very fast. The rate was given us 30%. Did they give us a rate? If they don't give us the rate, we just return it to them. 10%, thank you. So 5 years, 10%. The plan is useful life to be treated equally. New classic. Oh, they are saying due to market uncertainty, selling price. So these are average per year, average per year. So it is annual cash flows. They are saying annual sales volume. So whatever we're going to get as the expected sales volume is per annual, per annum. So we can comfortably say it is 10%, 5 years. And we don't have IO. So we only say that now minus IO. We don't have salvage. We don't have salvage. So it is minus IO. Our cash flow is 59880 times PVFA. What is PVFA? What is the value of PVFA? Calculate PVFA. PVFA ni ngapi? 7908. So it is 3.7908 minus IO, which is 250, right? So what is your answer? That answer is the expected NPV. If it is negative, you reject. Always advise. Why PVFA? It is PVFA because we are given the annual cash flow, annual sales volume. The sales volume is the same every year. And we also have the price. So if you calculate it, you're going to have annual revenue. So if it is annual, wakisema tu annual inamaanisha kila mwaka ni the same. We don't have a separate revenue for year 1, year 2, year 3, year 4, year 5. It is the same volume for all the years. So even if you multiply with the price, we are going to say that is the cash flow for every year. Sawa. Kwa hivyo ziko sawa, ziko similar. So we need to get the average, and that average will now act as the mean for year 1, all the years. Sawa. Kama wangetupia different cash flow for each year, then we use PV. I need this answer, then I just close the meeting. Let me call teacher kuje, tuanze LM. Get me the answer. Get me the answer. Get me the answer. So getting negative 23. Let me just call it negative 23. 310. 160. Your advice, always advise. Whenever you're getting NPV, always advise. Advice is reject the project. Since negative, since NPV, since expected NPV is negative. Expected NPV is negative. Thank you so much. Is there any question? Mimi nitawaomba tu next time, please keep on coming for revision. Keep on coming for revision. Don't give up. It makes you find the questions easier. Yeah, that is for revision, right? That is for revision. Hata hiyo revision anajua inasaidia kwa sababu hautakuwa na much time. Hata revision is Aya, let's log in.